All right, good afternoon. Today is August 11th. Today is Friday. Market just closed about 20 minutes ago. This will be your weekly take on the market. I'll be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed. Nobody at IBD is licensed. I'm aware of. We cannot tell you what to buy, sell, hold, how many stocks you should own, whether you should short. I could go on and on, obviously. These webinars, because they're pre-vetted, so to speak, for compliance, we can speak more freely on these. And so that's why you will get a lot more information on as far as that type of stuff on a video like this. Okay, we'll do market thoughts, industry groups, stocks to watch, and then of course the quote of the week. I think I did. I know I did. I did this chart last week, and so far so good. It's proved fairly prescient. The Dow is held up okay, but the Nasdaq is struggling a little bit today. Don't know exactly how it ended. I guess we'll pull it up, of course, but so the Dow futures were up 0.35%. The Nasdaq futures were down 0.6, and the S&P was almost exactly flat. So you have a really real dichotomy between the indexes. In the last handful of days, it's really started to show itself, kind of sparked by the SMCI report, which we'll talk about. I know a lot of people either watching that stock or had a position or used to have a position. So we'll definitely pull that one up. But it's just when there's too many people on one side of the boat, the boat tends to tip over the other way. And so I'm not super familiar with this index, but if it's correctly calculated, and it's only going back to 2018, I'd love to see it back a little further. But it just felt like it was a little bit too many people on one side of the fence. And so the market has shifted a little bit. Okay, let's pull up the indexes. Obviously, we're not going to jump to the industry groups just yet. Make sure I'm sharing, resume share. Okay, so here's a chart of the NASDAQ, and you had, I don't know if decisive is the right word, but you have a break of the moving average. Let me turn off my video just to make sure you can see that bar. The volume is, the market's volume isn't fully calculated just yet, but the volume is not all that great. Down here, down below. The relative strength, look at this though. It's very subtle, but you can see how it's slowly but surely turning lower. So it's underperforming the S&P, this relative strength. And this is the first close below the 50-day since, well, I'll include this blue day. What's that, March 11th of 2023, right in the teeth of the banking crisis, right? So right when everybody thought all the banks were in trouble and everybody had visions of the 2008 crisis dancing in their heads, the market said, well, we've already played this game before, and it's not going to happen again. And the market rallied. It's been a tremendous rally for sure, especially now it's been narrow, but in the right stuff, it's been tremendous. And, we're finally into correction, pullback, whatever you want to call it. We'll see how it plays out. But right now, I think, and I've said it before, I've said it on IBD Live, and I've been saying it for a couple of weeks, you really want to batten down the hatches. You want to really know what you own. You probably want to be down to a small handful of names that you really love, have a big cushion on, if you're one of those type of traders. Now, for me, I'm down to one name as far as long, because that's just how I trade. I just don't sit as well as most people, and it helps me sometimes and hurts me sometimes. But I'm not going to sit through correction and or a bear market. I don't care if I own Apple at a penny or Google or Nvidia, at $1 or Amazon. but other people can and have done that before. It's just too difficult for me. I just wouldn't be able to stomach the move. So if I look at, like, I go back and study, the first time I bought Apple was way down here, but I would have had, a couple $1 million worth of Apple up here, and I would have had to watch it go from, no, this is split adjusted, 6 to 3. So I would have turned 2 million into 1 million. And I just know myself, I never would have been able to survive that type of pullback. But other people can do it, and it's I don't know if envious is the right word, because envy is such a bad word. But I think I guess jealous. I don't know if jealous is the right word either. Jealous is this. It's not that great either. I think it's cool that people can do that, and I wish I had the staying power, and I'm trying to get better at that, but I don't have it. So enough about me. How about you? If you have, big gains and you want to sit this out, I think you've earned the right. The bottom line is, if you have a profitable trade, I think you've earned the right to sit with it. If it's unprofitable, then I think you want to be impatient with it, move on from it, and revisit it later if you love it. Now, the problem with that is, if you own NVIDIA at 100 or Apple at 50, it's unlikely to ever be unprofitable for you. But there could be an incredible time frame of underperformance. So, if you use that kind of strategy, if you bought Intel at 2 in 1992, you're never going to be underwater. But you've had, 20 years here. If you didn't sell it in 1999, it's basically at the same price 24 years later. So there's an opportunity cost in not selling Intel, for sure. You could add your money in the S&P, you could add your money in bonds, even if bonds were terrible yields, you could add your money in something else. So that's the dance that we always play, and it's not easy, for sure, but it's what we do. It's why we're interested in the markets. So the NASDAQ, underperforming. I would keep an eye on it. I don't think it's run for the hills just yet, but I would be down to my favorite names. S&P a little bit better, holding the 50-day, and the Dow a lot better. Look at the relative strength on the Dow. Very interesting that it's really turning up, and it could be like a place to hide. So if you're getting hit in your NVIDIAs and SMCIs and Apples of the world, although I think Apple's in the Dow now, right? You can hide in the Eli Lillys and the Caterpillars and the Deeres, because a lot of big money. The thing that I have to tell myself when I get bearish is, there's a lot of money, and when I say a lot, I mean incredible sums with a T, trillions probably, that has to be invested. It has to find a home. It can't sit in cash like I can personally. So I have to think about that and remember that when you see weakness in the market, there's going to be some areas that are going to hold up better than others because of that. Let's look at the Russell IWM. It's okay, not terrible, not great. How about EEM, which does have a Chinese component, and I think last night the largest developer in Chinese market, is it Country Garden, I think is the name. It's basically kaput. It's like a dollar stock, but it's been down for so long. I don't know why that was a surprise, but that kind of hit the markets a little bit. Let's do EMXC, which is ex-China, not holding up much better either. So you're getting some weakness pretty much across the board. And the bond market. So can't forget about the bond market, of course, because of the Fed. And not making new lows, but boy, this is really bad. It's just not a play. This is a monthly chart, and you can see this is COVID, right? Yeah. So you've had that's March of 2020. That's right in the teeth of the COVID bear market, and hasn't looked back since. That's 180 down to 95. So roughly in half. That's pretty nasty for a bond ETF. Okay, I think that's it for indexes. I believe IBD has market under pressure. I'm curious if they go to correction. Probably not after today. I guess depending on the volume today, but the S&P is above the 50-day. It seems unlikely they would go to market and correction. Highly unlikely, I would say. So I'm guessing they're going to stay at uptrend under pressure. But remember, one thing to keep in mind, see if I can share this. And you see in my ads, I bought those shoes right there. Those are on shoes. The uptrend under pressure, but this is most important right here. They lower their exposure to 60 to 80%. Eventually, we are going to change this, and I hope I'm okay to say this. I've already said it, so the cat's out of the bag. But they're going to make this more user friendly. More on the incremental, more on the exposure side. So this is the key. Don't just look at this. I'm trying to look at this. Look at what they do with the exposure. It's kind of like a recommended exposure. Up to 100. So that they lowered the exposure to 60 to 80. And that doesn't mean you have to be 60 to 80. It's just kind of a guide. It's kind of like telling you what, and I apologize, I had my screen paused. So I apologize if you missed that, but this is key. Again, lower the exposure 60 to 80%. That's most important. So look for that if you follow the big picture. Okay. Let's go to the industry groups. Make sure my screen, yeah. I don't want to do this video over. All right, industry groups. And I did see a thing where there was an email on the group strength where they were all showing high numbers because William O'Neill had an outage yesterday. And so the data that we get data from William O'Neill still, and they had an outage, they lost power. And so we were unable to get some of our numbers didn't update in time. So maybe this looks okay, but if you see something that's kind of out of whack, that might be the case. So computer hardware peripheral is number one. I think after this week, I'd be curious after tonight. I think that might lose its luster. Although, remember, SMCI has still made a big move even here. Computer software database, building maintenance, construction, residential, commercial services document. Let me pull this up. Really want to see if there's anything that's new. That's jumping out at me. Leisure travel booking 25 to 10. So what I'll do on a Sunday is I'll scan my eye down this path right here. And the higher up I am, I'm looking for big numbers. So like 57, insurance life, not really a group that interests me. So I'll go on from that. But like 104, 36, 20, building heavy construction. That's a big swing. I'd probably look at that. I don't know if I'd be interested in a building heavy construction stock, but I'm open to it. I want to review that group. Here's one, retail home sale furnishings, 170, 58, 27. That's probably like restoration hardware, etc. So I might review that one. Transportation ship, so 164, 42, 38. So I definitely would review that. I did make money in shipping stocks in the last, so I would double click that, pull up the chart, open up this panel, choose stocks and group, hit this button that says show all component data. And now down below, these are the stocks. So Toro, Kirby, Global Ship, Euroseas. I'm trying to find Zim. Interesting. So Zim was so bad, was so good for a while and then was so bad for so long. Let me pull that up and you can see it's You can't even tell. The chart's so scrunched. Yeah, I don't know. I think so. So that would be enough. I think that's enough for that. It doesn't look all that great. Kirby, I think I tried that one time. Is KEX? Yeah, just a little too slow. It just never goes anywhere. It's nothing wrong with it. It just never goes anywhere. So that would be that, and that's how I would review the groups to kind of get a feel. All right, let's jump into the stocks. And somebody asked for somebody sent me an email about shorting. I'm wondering if maybe I don't know. I'm open up a can of worms here, but I guess curious if maybe I don't know if I could do it every week, but maybe like once a month, like a learning lesson type thing in here. I mean, these videos are already so long because I ramble on. I know I need to tighten it up a little bit, but so maybe a learning lesson. That's something I could consider. But so let's look at stocks. So NVIDIA, let's start with that one. And my camera, I think, might be covering it. So I'm going to turn my camera. And I tried this yesterday thinking it might, when I say bounce off the 50-day, I was hoping it would turn green. It didn't. So I got out, and then I tried it again this morning at 417, and then I got out again. So I've already tried twice at the 50-day and lost a handful of points both times. And that's okay. I don't mind. I think it's part of my process, and I know it's not going to work every time. Let's see how it happens Monday. I'd like to see maybe Monday some weakness and something like that. So break below that, maybe open at 400 or 399. And then I probably will try a third time. After that, it's unlikely I would try a third time. If it opens higher on Monday, I don't know how I would handle it. I don't have an answer for that. But I always, it's funny how when they're running, when they're moving, right? When NVIDIA's here, it's like, oh boy, if this ever pulled back to the 50-day, I'd be such a buyer, right? We all say that. I'm just as guilty of that. So here it is at the 50-day. Well, sort of. It's kind of gone through it, and nobody wants it. And so you have to, it always looks easy in hindsight. It pulled back to the 50-day, pulled back to the 50-day, but at that very moment, it's a lot harder than you'd think. So this is a key stock. Now, the problem for me is you've got 12 days till earnings. And that's not going to give you much time to get much of a cushion. And so then are you going to sit through the earnings report? Now, the last earnings report was gangbusters, which is both good and bad. It makes me wary that, the market is building in an expectation of, really strong earnings report. And we all know that unless the earnings report from NVIDIA is exceptional, the stock's probably going to be down. The good news is it's sort of already down, right? It's down 15% off of the 52-week high. So, if it's down another 10%, it's 25% correction. This might be the start left side of a potential base. If you own NVIDIA, you finally got what's the right word I'm looking for? You've hit a crossroads on how you're going to handle it. It's been, I don't want to say it's been easy because they've never been easy to hold, but it's been easier to hold. And now it's getting a little bit difficult. So how do you handle it? You have to decide. I would say maybe, this is why I like to reduce. I mean, I got out of NVIDIA all but the tiniest of position here on this rally. And then, I was happy here and sad there, but now I'm glad that I'm out of it. And I have the tiniest of position, and that's why I keep trying to add to it and then, with real size and then get out, add with it, real size, get out. That's what happened the last 2 days. Very interesting. It's a super, super tell for the market. SMCI was another super tell for the market. And, this was a clue that you probably needed to do some lightening up on, whether it was SMCI for sure. or other stuff. Now, remember my rule that I talked about when they gap down, right? If they gap down, now I don't know if this is exactly where it opened, but I do remember it opening near 300, and that's pretty much the high for the day. So just to make it easy for myself, you have 1,000 shares, you should be down to 700 or 600 or something on the open. And then 5-10 points later, you're down to 300. And then 5-10 points later, you're out. And, your average price might be 285. I know it's not as good as 295 on the open. And I did see some people saying, well, you should just sell it all in the open, which is fine. Yeah, go ahead, sell it all in the open. But I'm talking about what's psychologically possible versus, we don't trade in a vacuum. We trade in, reality. There's emotions, there's all of that involved. So I think this process is easy to replicate. The process of selling it all in the open is difficult to replicate because you have that fear, that regret that if I sell it all and it comes back, what's going to happen? And that doesn't happen that often, but sometimes it does. And it just will eat at you for a long time. So do something, get out of some of it, even 20, 30, 40, 50% of it, do something, get in motion, and you'll get feedback that you're wrong. So for example, I can tell you that I bought NVIDIA this morning. I think I paid $417. Let's go to 60 minute. Let's go to the 15 minute. Yeah, so it gapped down, and I was hoping to catch something like this, but also like that, like a real move like this. And it ran to 420. So at one point I was up 3, and then it gave it all back. And then I was like, oh, that's not good. And the funny thing is, there was the NASDAQ at that very moment. Look what the NASDAQ did. It was going straight up. When I say straight up, remember this 15-minute bars, but boom, 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 they rallied it. And I was watching the NASDAQ go up, and I was watching NVIDIA go down. And that was all I had to see. Done. Move on. Sell it. I mean, this is the best stock in the market, allegedly, and the market's rallying and it's going down. That's all you need to see is little clues like that. So time to move on and reevaluate again. So for SMCI, you take the good with the bad with these incredible leading stocks. When they're good, they're incredibly good. And I see a lot of people on Twitter, they fall in love with these names and they just kind of lose their discipline, forget how to sell. And so you have to have some kind of sell plan. And if you find yourself freezing, have a sell plan on your book with your broker, so you don't freeze. So that way, if you have 1,000 shares, maybe you just stagger some trades. Sell 200, sell 200, sell 200, sell 200, something like that, all the way up. And I don't know, there's a million ways to do it, but you have to have a sell plan if you're going to traffic in these high flyers, these big liquid relative strength 99 stocks, because this is the reality of nowadays, is the information moves so fast. I mean, the stock went from new highs to 50-day in 2 trading sessions, and it's down 30%, 28% in 1 week, and looks pretty broken. It looks like the end, at least for this get-go. Maybe it builds another base and makes another run, but it's these types of bars on weekly bars are they usually don't overcome this type of action. You got to go back and study it. This is really not a very good sign. All right, so there's Supermicro, there's NVIDIA. What else is out there that I think I talked about the FANG stock. So let's look at FANG-U. I can't get over this looks like a head and shoulders top to me. If that's the case, this is the neckline and you're right there. Now, even though I am shorted, I actually think there could be some type of rally before it were to do that. That would be typical. looks a little too, the right side looks a little too fast to the downside as we sit here like this. But, you know, pretty heavy. Apple looks very heavy. Netflix. Now, FANG is made up of all these stocks, so that all the patterns kind of look the same. Tesla, it's kind of interesting that all these stocks looks exactly the same. So when they're good, and when they're bad, they're bad. So they all kind of look the same, but it might be a little early on this right side. I don't know if that's how it plays out. Might be just a few days to weeks early. I'm open to it, but you know, I see some bearish setups, but yet I'm still willing to try. I'll go along, you know, Nvidia, like I said, because if there's a rally, that's the best one, and it should go up if the continuation of the uptrend is still out there. On the resource side, there's, you know, Tidewater, which had a really good shakeout, and this is a great example of that FOMO. So if you sell all of it at 57, in 2 hours it's 67, and you are just going to be beside yourself, and it's going to be hard to overcome that. It's going to ruin your mental capital. So let's say 1,000 shares of Tidewater, it's going to gap down and you sell 200 or 300, and then boom, 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 it comes back. You can always buy that 300 back. You know, you just call it a little insurance policy. You sold it 57, you buy it back at 60, 300 shares only. You capture the rest of that move, or you just say, you know what, that's okay, and I still have my 700 shares. So this was a nice little shakeout on earnings that somehow I survived. From a weekly standpoint, very interesting. So it held at the 10-week, closed in the upper range, 64%. Volume is big. We'll wait and see. I don't own as much as I did because on Wednesday on IB Live, I said, you know, the stock was 67 and then it was 66. And I thought to myself, you know, at 56, I was ready to puke it up and get in, start selling, because I was ready to hit the bid on the open. And here I am at 66, happy as a clam. So I said, I better do some selling. So I reduced my position at 66, not as much as I wish I had in hindsight. And then at 65 and 64. And that's one of the reasons why I like to give the market orders, because I can get myself an anchor. So now I'm anchored to 66. That looks like a fantastic sell. So at 65 and 64, I'll do a little bit more selling. So if you still own this one, I think it's acting just fine, but you know, it's going to be you're kind of a part of the market, and obviously the oil market. Valaris finally got our handle, whether it's daily or weekly. This is going to be a handle on the weekly after the week closes out, once it sees that. So you've got the handle here on the daily. You see this downtrend line that I've drawn. I do own this one, and I will buy more if it goes through there. What else is out there? Oh, so VRT is a good one. So I sold on the earnings, and then the next couple of days was like, okay, you know, maybe that was a bad sell. My instinct was to sell, and I should have just sold part of it, but I couldn't help myself, so I sold it all. But then I bought a little bit more back. I think it was this day or the next day. I think it was around 35, 34 and change, something like that, high 34s. And then they announced that secondary. I believe it was 20 million shares was the secondary. And so once they did that secondary, now I've got a nice anchor to create a stop. So on this day right here, I don't know if that was the day they priced the secondary, but August 9th was the day that I was on IBD Live. Is that? Yes, Wednesday. And I wanted to know the secondary price because I need to know where all the institutions bought the stock. So there were 20 million shares and the price was like 34.87, something like that. So there's 20 million shares changed hands at 34.87. And there are a lot of new buyers that are anchored to that price at 34.87. Let's just use 35 to make it easy. So this is how stocks can go up and then how they kind of tend to go down, because as the stock's going up, there's when a stock's a new high, there are zero upset shareholders, right? There's guys and gals like myself that are taking profits because we just do that, but very few people are upset at the stock. So there's no pressure on the stock to get out when they're at new highs. And when they do a secondary, they do 20 million shares, which is, how many shares are in the float? 300 million. So, it's not a ton, but 20 million shares that are now underwater. There are 20 million. Let's pretend there are 20 million institutions that bought or that bought a single share. They're all underwater. They all paid 35. So now they have $1.50 loss. So you've got this overhead resistance that just all of a sudden shows up once they do that secondary. And that's where I put my stop. I just put my stop exactly at the secondary price. I think 34.87 or 34.90 or something. And I actually just put a stop on the books. That way I didn't have to worry about it. If it went there, I didn't want to own it anymore. And I got stopped that same day on Wednesday, 34.87, something like that. So I'm not in that. And that's to me, that's kind of a ceiling now, 34.87. I hope the stock can build a base or something. And when I studied big winners like this, we're going to spend some time on this one. Bear with me, guys. So Rollins, I can't pull it up, continued. Microsoft, an outlier, one of the great companies in all of times, continued. Gap is a good example, GPS. So Gap in 1986. So Gap goes from 6 to 20 right there. So more than a triple, a lot like VRT. VRT went, like a triple and had this big week. It was up 20%. VRT was up like 30. And you can see it was up the next week and next week. A little shakeout tail here. But from this point, the stock doubled again. So there was a precedent for me. Now, if you want to take the opposite side, was Ben Franklin. And you can see this is up 29%. Stock's already made a big move, right? It's gone from 8 to 50, a little bit more, 8 to 40 at this point. So it's made a big move, a lot like VRT, off the low, big move. And it went up for a week and then got real choppy. So I was looking for, kind of how it might play out. And I was hoping it would be the GPS, the gap scenario. So here it is, 12 to 34. It's like a triple. And it made a big move. So I was hoping it'd be the gap scenario, shake out, and then another move up. But I had to have a stop. And the secondary made my decision on where to put the stop easier. So that's how that one played out. What else is out there that I know is high on people's radar? Let's go to Meta. I think that was an easy sell if you were long Meta. Now, I wasn't long it, so it's always easy when you don't own it to decide, but it's the old if not now, when. Microsoft, I actually was shorting into this, covered way too soon, but I tweeted on Microsoft, Meta, I can't remember the other stock, Apple, I think. If you use strength to sell into, if not now, when, right there on Microsoft. Meta, maybe I think it might have been a little bit earlier. Was it in here? I don't remember. Either way, it was a little bit higher than here. And then in Apple, when they had their little attempt at AI. So it gotten a little frenzied, and Microsoft comes out with their AI thing. It jumps. Apple mentions AI. It's just you have to, when you hear that over and over and over, you're getting, the odds are increasingly that it's near the end of the move, not the beginning. Now it might not be the end of all time move, but in short term. So this looks very pedestrian, and I am short Apple by owning the AAPL, which is the Apple inverse. I'm sorry, AAPD, which is the Apple inverse ETF. Now, I'm not going to get rich shorting Apple. That's fine. It's not going to. It's Apple, right? It's not going to UPST it, which I can pull up later. But it's a nice, hedge, so to speak, against being long other stuff. And it just looks to me like the earnings and sales I talked about last, they're just pedestrian. So, and if I'm wrong, I can get my stop. I'm not going to get, Apple's not going to get bought out. The better shorts, and this is where the lesson comes in, because somebody was asking about shorting, is you really want to short stocks that by the old Wild West adage, shoot them in the back, right? It's not very sporting, but you always have a better chance of winning a gunfight by shooting a guy in the back versus facing up with him. I don't care how good you are. You face up with enough guys, you'll probably end up in a coffin. So I think Bill Fleckenstein, who's a famous short seller, I stole that adage from him. He says, I like to short by shooting them in the back. In other words, they're broken. And so when they break, that's the time to short them. You don't want to try to short the top. I think I might have told the story before, but it's important. Bill O'Neill there was an article on IBD, I think, and the article said you should short stocks 7 months after they topped. And some guy at a seminar said to Bill, who wrote that article? Why do you want to wait 7 months before they top? That's ridiculous. Which moron wrote that article? And Bill said, or who came up with that idea? And Bill said, that was me. I wasn't there, but Bill would tell that story and laugh. I would laugh out loud. That's such a great story. So you want to wait till they're broken, and wait till they've topped 6-7 months from now. Now, I don't always follow that. Do as I say, not as I do. So, like the Microsoft short, that was very unique situation. That's a lot different. And even for something like Tesla, it really hasn't broken completely. It's only a couple of weeks from potentially the top. But if I, and this is just to justify my trade in my own mind, if I go out weekly or monthly, you can see the top in Tesla was, almost 2 years ago. So this might be like you could see how it rallies, fails, rallies, sort of fails, rallies, and then my hope, based on the trade I have on, is fails. And so shorting is very difficult. My recommendation for people is, if you're a doctor, a lawyer, you work on an oil rig off the coast of Norway or whatever, you don't need to short. Just do your job, contribute to your 401k or whatever it might be, and build your account, and make money on the long side, because that's where the big money is made. If you really want to be involved, like you just say, well, why can't I be involved, Scott? If you'll do it, why can't I? That's fine. You can try it. I would say maybe take a portion of your account, or maybe even set up a different account. So if you have $100,000 margin account, maybe take 25 of that and take it to another broker and use that 25, and that's the account you short in. And that way you can see, is it working? They'd be black and white. If that 25 is 50, it's worked for you. If that 25 is 20, and your other account, which is 100, back from 75 because you took 25 out, there's all you need to know. The proof's in the pudding. And so I would say, and you really should probably segregate it, separate it that way. You can't kind of fudge the numbers in your mind. It'd be real easy to know if you're any good and making money at shorting, because you'll have a dedicated, shorting account. It's probably not a bad thing for me to consider. I have more than one brokerage account. I have accounts, in a few places. Maybe I ought to make one of them a shorting account. Food for thought for myself. So, all right, I apologize. This video is running long, so let's move on to the quote of the week. Okay, it's funny that this is the quote of the week, because this founder CIO of Worm Capital is, I haven't looked in a while, but there was a time he had a massive portion of his fund in Tesla, and I would guess he still does. And I'm talking about shorting, and I'm sure Tesla. And here's the quote of the week. But he did really, really well in Tesla. Been in it for a long time, so way better than I did, that's for sure. So long-term investing boils down to two fundamental components: stock selection and position sizing. This is practice. This is exactly what they preach at William O'Neill in the portfolio management side, over and over and over. Stock selection, position sizing, market, being in sync with the market. That is the key. Like Steve Birch would say, this is the key to William O'Neill's outperformance for years and years and years. When I say William O'Neill, I mean not only William O'Neill himself, but the portfolio managers that also run William O'Neill company money. Great at stock selection, using the tools we have, willing to put on size much larger than Wall Street would ever put on. Like in Wall Street parlance, way over concentrated. Like for Fidelity or T. Rowe Price, or for somebody like that to have a 10% position would just be massive. And in-house, like a 10% position is like a typical starting position. This new era, we must emphasize sizing here is imperative. We believe academic concepts around proper diversification can be out of touch. In our view, concentration, our best ideas at the proper weighting is our best chance at protecting capital. Interesting. By being concentrated in their best ideas, they believe it's their best chance at protecting their capital, beating the market, obviously, and attempting to deliver performance worth paying for, because they do run a fund and people give them, I'm guessing, some type of performance fee. But I love that part, that it's the best chance of protecting capital. If you own 5 stocks and you sell one, you've reduced, and they're all equally weighted, you've reduced your portfolio by 20%. If you own 500 stocks, you'd have to sell 100 of them to replicate that same type of move down. So there's a sweet spot for the number of stocks you should own. I think it's 10, but it can be, stretched to as many as 20, 25, if that's what you need to help you to sleep at night. It's no good if you can't sleep at night, but I don't think you ever want to own more than 20, 25 stocks. You're not going to get the diversification that you're doing it for. And if you get one right, you're not going to have enough money in it that it can move the needle. Okay. All right. Contact information, marcussmithinvestors.com, 800-424-9033. As always, I appreciate your feedback. You guys are great. This has been fun. As long as it's fun, I'll keep doing it. As long as there's demand for it, I'll keep doing it. I think it's been great for me, because it really keeps me on my toes, and the talking out loud is like the whole shorting thing that I talked about. All of a sudden, a light bulb moment went on for me. I should have a very specific short only account. That way it's easier to manage or follow the performance, see if it's worth it. Okay, 800-424-9033. Have a great weekend, everyone. Bye-bye.